Hello, my name is Perry Zhang. I'm the founder and CEO of Pallas. Pallas is a Y Combinator-backed startup that helps you invest passively. Today, I want to talk about underwriting. Underwriting is usually the first step that you do when trying to buy an apartment complex. Actually, before I start, some of you may actually not know what underwriting refers to. So, in its simplest form, underwriting is just the definition of a general partner trying to analyze the property in order to buy it and determine what price to buy it at. Now, you might say, why don't you just call it analysis? So underwriting is just a fancier way of analyzing a multifamily or any deal. And so when you hear about the word underwriting, you might think, oh man, this is like a insurance company trying to underwrite my policy, or the underwriter, a loan officer trying to underwrite my single family mortgage. And so it actually means the same thing, because when you get into the multifamily level, a general partner is also underwriting their deal. Every vendor is underwriting it using different lenses or different considerations. As an example, a property management, an insurance company might underwrite it for the potential of different types of units to make sure that none of the units have the right build characteristics so that if a fire happens, their out-of-pocket expenses will not be as much. The mortgage lender will underwrite it in a way that makes sure your income will cover their loan amount, because as a lender, they don't have any upside, they only have downside, right? The commercial broker will underwrite it in a way that just makes sure that it's always appealing to the buyer, or because they're representing the seller, right? And so you, if you are a general partner, you will underwrite it in a way that you will consider all your vendors first, and then you will underwrite it in a way that's such that your investors will have a great return. Now, if you're the investor, you will underwrite it in a way that makes sure that the general partner is quote unquote telling the truth. So underwriting is usually the first thing you do in a multifamily transaction, even when you start buying it. But it just means analysis. Now, you might ask, why do we call it underwriting instead of some other term? It's just like a big boy word, I guess. That's why. That's the only reason I can think of. I got to know about underwriting when I joined a mentorship group in 2019. My business partner and I joined it. And I remember I was super nerdy at the time. It's the first bus tour, they called it the bus tour, where you go on the buses to check out the properties. After the bus tour, the next day we were hanging out at a golf club. And this is 2018, early 2019. And I had my backpack with me. I carried my laptop and I took the spreadsheet to the golf course. And thankfully, there were some very kind people, some very prominent general partners at the time that point out a few things on me. And so they actually end up investing in the company. And I'm forever grateful for that. I was good at math, I used to joke that, I got a perfect score on the SAT for math, and my real estate business partner got a perfect on the verbal section of the SAT. So together we have perfect SAT score, whatnot. So I was good at math. And so I took a first step at it, and this person said, hey, look at your underwriting. It seems like the first year, the total income jumped by 12%. And then the second year, it jumps by 6%. The third year, it jumps by 5%. And so that is too high for 12% on the first year. That's not believable, right? But what you can do is you can lower the economic vacancy on the first year so that it becomes more of a 8% growth on the first year, and then a 6.5% growth on the second year, and then a 5.5% growth on the third year. So as you can see, that one sentence was basically telling me that there are so many layers of underwriting. The first level of underwriting is you basically plug in the numbers. The second level of underwriting is you understand the perception of that underwriting. The third level is actually going back to the basics, is how much per unit is each property. So let me kind of go through some of the things about underwriting. If you don't know anything about underwriting, here's how it works. You have a spreadsheet that has the metadata about each property, such as the year built, how many units, some of the roof, and you have what's called a unit mix. So, A1, it's a 1 bedroom, 1 bathroom. It's renting for $950 in Dallas, Texas, and it's got this square footage. A 2 bedroom, 1 bathroom is renting for this. It's got this square footage. So you have this unit mix, and this is the current rent. Now, the current rent is actually not easy to determine because the rents are all over the place, right, in a typical property. So you actually have to look at the rent roll and determine what's the average rent or the median rent, and then determine what's the asking rent, and so on and so forth. Then you plug in what you think is the pro forma rent. Pro forma rent is simply what you think the rent is in today's market. And the pro forma rent is interesting. It's actually an art. You figure out the pro forma rent by going to check out the comparables around the area, and you figure out the pro forma rent by asking your property management company, or you just use some go to apartments.com and figure out. When you check out the comps, you can actually pretend to be a tenant. Or, which I suggest, just say you're the owner and trying to buy the property, because the on-site manager usually is very nice to you and tell you the truth. That whole exercise, by the way, takes about 30 minutes because it's not easy to figure out the current rent. Okay, so that's the first step, which is what's the rent. The second part is what's the loan amount. Loan amount is what kind of interest rate, how many years of interest only. And so you plug that in. That usually requires a quote from your loan broker. You project the expenses. So what is the current expense, which you also get it from the trailing 12. And then you get the pro forma expenses from the property management company. So as you can see, that initial stage, this the rent, the expenses, and the loan amount. So those three kind of make up the triumvirate of underwriting. But determining each one of those, you can determine it by yourself. You can determine it by shopping yourself. You can determine it by using sources, or you can determine it by using vendors, right? So that gives you a sense of how do those numbers come about. As you can see, to do a thorough job, that takes enormous amount of time, and there are many processes in which you outsource the figuring out of the current rent to a virtual assistant, or you use a software to figure out the current rent. And the pro forma rent is an art, right? Sometimes people use what's called CoStar, which is a company that offers all these analytics, or you just talk to a property management company. Now, and then there's the kind of the fourth part, which is the projection about the future. Projection about the future, I will not get in too much into detail. There's this term called the reversion cap rate, which is how much you think this property will sell for at what multiple of the income what it sell for. If it's a high multiple, then obviously you will sell for very high. In that case, the reversion cap is lower, because the reversion cap is the income, the net operating income divided by the price. So the lower it is, that means the larger the denominator, which means the sell price is very high. And the sell multiple is actually just the inverse of the cap rate. Okay, a typical cap rate is 5%. Now it's still pretty low, and so a 5% cap rate means it's 1 divided by 5%, which is 20x multiple. Okay, now you might say, wow, Perry, you just say all this really fast. Don't worry about it. I'm just giving an intro to underwriting. The goal is not that you understand all of it. The goal is to give a sense that this is actually really complicated, and that's why as a LP, your life is pretty simple. I'm sorry to say that. But yeah, so let me kind of summarize what's going on. You have the metadata about the property. You have the kind of expenses that you get from the property management company. And then you also have the loan, which you get from the mortgage broker. The expenses itself has 20 different parts. There is the contract services, there is the administrator, there's the utilities, whether you want to do some utility savings or not. There is the property tax, which then you have to talk to a property tax consultant to see how long you can get it down. So you can go down this rabbit hole of figure out this complete picture. So what does a general partner do when they don't have complete information? So what they do, and this is something I will also recommend that all of you as passive investors or general partners do, which is to take their trailing 12, their income statement, figure out the average rent, and that's the current rent. and then figure out the maximum rent they are already getting on any of those unit types. That could be your pro forma rent. Why is that a pretty good estimate of a pro forma rent? It's saying that, well, I already have at least one data sample of something that is achieving this kind of rent, assuming though, it's not like being bribed or this is a legitimate rent. And so what you can say is, if for the sake of argument that I could achieve this high rent across all my units, would this property still make sense at the price that they are? There's so many lingos in multifamily. What it's called the whisper price. So in the package that the broker sent out, they never say how much price is this listing for. Unlike single family, it's saying, give me an offer, give me multiple offers. But if you ask the broker, they'll say, okay, what is the yes, there's no listing price, but what is the whisper price? And they will tell you the whisper price. So whisper price is basically what's the first level of price that you need to get into the best and final. So if that price, if by using the maximum rent, it makes sense for the best and final. By using the maximum rent, then the deal works in terms of the price. Then this is negotiable, right? This is something you can play with. But if it doesn't even make sense in that level, then it's over. You just can move on from that underwriting. So underwriting is more of a decision tree that you go down this decision tree and you can prune off multiple branches of that tree. The best way to do a underwriting, to be honest, is to get into a group with someone that is, that likes math. And I also understand that not everyone like math, and some people are more, personal, about people's person. I started my multifamily career as more of an analytical person that it took me a month or 2 months to understand all the intricacies of underwriting. As an example, my first bus tour of the multifamily mentorship group, I was this nerdy person that tried to play with the spreadsheet. I brought the laptop to a golf course. How nerdy can that be? What's the point of this? We're going to talk about how do you get better at underwriting as a general partner or as a limited partner, and what is it first of all? The way to get better in underwriting is, I talk about multiple levels, right? There's the crunching of the numbers. That's the first level. Then there is the projection about the future. Projection about the future, by the way, is very much tied to your business plan. If you have a great business plan, even if you feel like the future is quote unquote bleak, you can actually do a great job on, for example, this is why you learn so much by joining some sort of mentorship group and then really capitalizing on the relationships. So one time we went to Dallas and we toured some properties, and one of the general partners that is a good friend of ours came with us just for trying to help. And they saw something that we wouldn't be able to detect. They say, oh, here are some empty spaces. You can add a couple, sheds for self-storage and charge them. And that they will want it because over there were a bunch of construction workers with their trucks out. So they will love some place to store their tools. And so, that if you can build, 10 of those, each one charges them about $50 a month, then that's $500 extra each month, and so on. Or they will say, okay, here is a shed that is a maintenance shed that you can make it into a unit. Now those things add up. Now you can also say you don't want to do too many of those because each one of those projects is a layer of uncertainty. And when you do too many of them, then the uncertainty really grows exponentially, right? And this is why that's the second level, which is business plan and projection about the future. Projection about the future is a fascinating topic, right? Right now I'm looking at a spreadsheet. You don't see the spreadsheet, but just take my word for it. A property that is 90%. Okay, let me just show the spreadsheet. So you can see here is a property that gets about 82% return and 5.7% cash and cash. Okay, for the sake of argument. Now, right now the reversion cap is 5%. Okay, so all of this, you can see this is a 5% year one growth, 6.7% year two growth, 5%, 2.9, 2.9, 2.9. Very, very reasonable, right? This is good conservative underwriting. And then when you do all the expenses, you will figure out that the expense ratio is about 46% in certain demographics and 55% in other demographics and 35% in other demographics. So there are so many rules of thumb. Now, this is a 5% reversion cap rate, and 5% reversion cap rate is 82% total return. For the sake of argument, if I change this to 4.8%, look at that. The total return becomes 92%. So if you're listening to this as a limited partner, when a deal has 92% cap rate, you need to ask what is the cash and cash, because you can see that 0.2% difference changes something from 82% to 92%. By changing a number that is 0.2, like dial 0.2, the unsuspecting investor will be like, oh, this is a great deal, versus that we not promise, but projected 5.0, right? So what did I learn from underwriting? It's easily gamified. That's why I always say the general partner matters more than the deal, because whatever numbers you see online, because some folks have keys to knowing the numbers, they know how easily they can be manipulated. And that's not a bad thing. That's just simply nobody knows the future, right? If you know the future, if you know exactly how much expenses this property will be, you are wrong. That I can guarantee you are wrong. So we talk about the different levels. The first one is number crunching. Second one is business plan. Third level is some sense about the future. And everyone's kind of sense is different. Their sense is also externally motivated, right? For example, if I'm a general partner, obviously I'm going to tell you that the future is bright. So just, know that. And so then the fourth level is this once you become unconsciously competent about something, you just be like, yeah, in Dallas, this zip code, this area, this vintage is $140,000 per door. It's just like, that's the number that it will sell for. And do I believe that in 5 years it will sell for $190K a door? Maybe, maybe not. But I think it's $170 easily, $180,000 a door in 5 years. Here's a really interesting anecdote. We were trying to buy this property, and I said, I want this kind of concession, and it's a $2.1 million concession. And they were like, no, we're not gonna take the I said I want a $2.8 million concession or retrade, because this is during the economy softening and whatnot. We end up with some other number. The point is, at the end of that time, our team was underwriting based on all kinds of numbers and based on all kinds of comps, and then they were doing all the math, and they were like, yeah, $2.8 million off seems exactly correct for our purpose of underwriting. We end up getting 1.9, so quote unquote we may have overpaid by $900,000, but it's a large property, so it's it is what it is. So on this property, I said we need a $2.8 million retrade, and the team is like, no, this is too high, and so we end up settling on 2.1, 1.9, some number. So, but you have to somewhere in between. The emphasis though is why 2.8, right? How did Perry just come out with this number out of nowhere? So they were doing all kinds of analysis, based on the reversion cap rate and the expenses, the property tax, the loan amount, blah 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 blah. And then at the end, they're like, oh yeah, $2.8 million is it will be really cool if this property sold for this price, and that's a $2.8 million retrade value. So how did I almost skip all the analysis to come up with this magical number that basically was also the result of hours and hours of underwriting? Well, I just peg it like it's $140,000 a unit in this area. That is the price I'm willing to pay. I'm also willing to pay about $145K or $148,000 per unit. That is also the price I'm willing to pay. And I believe that in 5-7 years, it's gonna be about $180,000 per unit. And even if the worst case, I still make money. So it's kind of funny. You go through this whole cycle and you come out with the same results, which is you can do all the number crunching, you can do all the business plan, or you can also say this is what the value of the property is. Like, this is why I love the name Pallas, which is this ability to really think about the intrinsic value of something, right? And so they were also amazed, like how that number coincide exactly with my retrade value. And it seemed like I came from a position of like intuitively, this is how much it should be. And then my business partners came from a position of like, this is the result of our mathematical analysis. So that's what I will say. At some point, you will get to a point you were like, yeah, I know Texas, or I know Dallas, or I know Austin, or I know like whatever market that you're choosing in, this is the price. And you can just go off that. And this is why some of the best operators in real estate, they don't use spreadsheets. They just be like, I know this market, I know in this region, it's gonna be $155K a door, period, for this kind of vintage. And so if someone gives them a property, a multifamily property that is around that or a little bit less than that, they say buy. They can make a decision on the spot within 24 hours, right? And that's an impressive skill set. And so what's the takeaway from this? The takeaway for the audience is not to like almost like trust the GP more than the numbers to some degree, but you have a very analytical eye on like spot fishiness on the numbers. If you don't agree with the numbers, like look at the price, look at the per unit. Is this a reasonable price for that area? And so there are many due diligence one can do to spot fishiness or to support the claims of the general partners. Every deal that we have done has not gone exactly according to plan, but it's all the pivots and the ability to respond to adversity in every deal that is what sets apart a good general partner from a so-so one. So yeah. Underwriting is fascinating. So thank you again for watching and happy investing.